So the market has hit an all-time high, and the number one question on everybody's mind is what happens now? And the truth can be scarier than you think. So usually what happens when the market hits an all-time highs is it continues to rally. Let's take a look at this chart that shows what happens after the market has a 20% year like it did last year as we emerged out of the bear market of 2022. And if you take a look here, usually after a 20% year, the gains do continue. Since World War II, what follows after a 20% gain in the S&P 500 is an average of a 10% gain. And we've seen plenty of times in history, if you just take a look at the monthly chart of the S&P 500 that I have here, there are many all-time highs that are not corrected. As a matter of fact, the market can keep going up for years and years. But as someone who aggressively researches this day in and day out, I'd be lying to you if I told you that I wasn't worried here because of a few factors that we have to discuss. This is not just any all-time high. This comes with a lot of conditions and caveats. So if you're interested to know what happens here, stick around and make sure you are following me on Twitter and Instagram for free daily trading and finance content. Let's go. So as I said at the outset, if you look at the S&P 500 over years, it can create all-time highs without ever correcting for years. There's this really annoying mantra that comes from gambler's fallacy that says what goes up must come down, right? That's what every bear person thinks. However, there are so many times when the market creates all-time highs where it doesn't correct. And there are times when it does correct. So let us go over those times because I'm afraid that we are potentially in one of those scenarios. First, let's talk about the yield curve, okay? Now, I'm not going to bore you, especially for those of you that aren't into bonds, but the yield curve is basically between the 10-year yield and the 2-year yield. What happens pre-recessions is this inverts. Now, I'm not going to get into why. I've described this phenomenon tons and tons of times on my channel. But the yield curve inverts, meaning the 2-year starts paying a higher yield than the 10-year, which is crazy. But this happens before recessions. You can see it here before 1980. You could see it here before 1981. Now, this period right here is going to be an extremely important period that is going to apply to what is going on now. You could see it here before the 1990 recession. You can see it before the 2001 recession, before the 2008 recession. The yield curve inverts. And then once it uninverts, right, once it normalizes again, then we usually tend to see a recession because that is when the 10-year yield usually spikes and the 2-year yield tanks. Again, I'm not going to get into why. But what you notice here is that the yield curve has been inverted for a year and a half, and it is now getting close to being uninverted. Now, nobody knows exactly when, but we are currently seeing the 10-year yield sharp risely against the 2-year yield. And I've shared this before, but if you take a look at the recession probability here, you could see that the recession probability for April, May, and June is actually pretty high. Now, we've never had a yield curve invert and uninvert without getting a recession. This is one of the precursors of a recession. Now, naturally, one of the things you might be asking yourself is it common to have double dip recessions? Meaning, if we had a recession in 2020 after the pandemic, would it be very common to have a recession shortly thereafter? Well, not common, but it has happened before. So let me point you to 1980 and 1981. As I said, this period is going to be extremely important. The yield curve inverted, uninverted. We had a recession in 1980. Yield curve inverted again, uninverted. We had a recession in 1981. Same thing here. The yield curve inverted in 2019, uninverted in 2020. Recession in 2020, and then it inverted once again in 2022. And when we get an un-inversion or a normalization in 2024, I expect there to be a recession because that's what the data tells us. It is not my opinion, just based off of a baseless claim. It is based on actual data. Now, before I jump further, let's take a look at what happened to the market, because remember, the economy and the market are not the same thing. But let us take a look at what happened to the market. In 1980, we did have a drop of 21% and then a rally followed by a drop during the 1981 recession of 27%. So this was a double dip recession and a double dip bear market. Just like we saw here in 2020, where we had a decline of about 35% and then a rally. If we do get another recession in 2024 and we get that yield curve uninversion in 2024, then we could see a very similar scenario to what we saw between 1980 and 1981. Now, if you're a really informed type of viewer and you like to draw conclusions, you might say to yourself, but Z, Could you actually have a recession and not a bear market? Well, luckily for you, I got the answer. Looking at history here, you cannot have we've never had a recession without a bear market. Now, we've had bear markets outside of recessions, but never the other way around. Every single time we've had a recession, we've had a bear market. Look at it. It's right here. Also, imagine buying the S&P 500 for $6 back in 1933. That'd be wild. Now, one last thing I'll say about this before I move to another data point of why this could be a scary time, the fact that we hit all-time highs here. One minor point I want to make is there isn't a correlation between the length of the recession and the length of the bear market, okay? So there have been times when we've had a pretty long recession and a not so severe bear market. And there's been times when the recession hasn't been that long, but the bear market has been extremely long. One example of this is in 2001. You can see the length of the recession was 8 months. The length of the bear market was 31 months. You contrast that with a lengthy recession of 18 months and a bear market length of only 17 months, half of what it was in 2001. So snapshot this, save it, whatever, but just know that there isn't a real correlation between length of a recession and length of a bear market. But again, every time we've had a recession, we've had a bear market. Now, aside from the yield curve, the second thing that I want to bring to your attention is the S&P 500 election cycle. We are in an election year right now in 2024. So what happens during an election year? Well, maybe it's not surprising to you, but election years are generally bullish. As a matter of fact, 83% of the time, election years actually end the year higher than they started. So we are in an election year now, but I want you guys to think about something. Do you remember what were the last few recessions that we had? 2020 was an election year. 2008 was an election year, and 2000 was an election year. All three of those were some of the worst bear markets that the S&P 500 has ever experienced in terms of drop. 2020, it didn't last long, but the drop was 35%. Nothing to laugh at. So all three of those things came during election years. Now, it's not merely the fact that, those drops came in election years, so it's a hit or miss thing. No, it's not random. One other thing that happened is that these were pre-recessionary times. Now, if we go back to the yield curve, this is definitely a pre-recessionary time. I would put my entire life savings on a bet that if this uninverts, we will hit a recession. Why? Because it's happened every other time. Also, when the stock market hits an all-time high, I want you guys to pay attention to where rates were. So during an election year, when rates are down, when we're not in a hiking cycle, everything is hunky-dory. There's a lot of liquidity in the market. But if you take a look at this 2000 recession, the 2008 recession, I want you guys to take a look at where interest rates were. Interest rates in 2000 were at peak, right? This was the peak of this rate hiking cycle. It was after this that the Fed actually started dropping rates. I will link to this article in the description. It is excellent. It details the history of rate hikes, rate cuts, and the federal funds rate throughout different periods in time. So it is a really excellent read. So I encourage you to read it if you are interested. Now, if we take a look at when the markets hit an all-time high in 2007, right before the 2008 recession, rates were at 5.25%, which was the peak. And in September, they did a 50 basis point rate cut because this is when September 2007, when stuff started unfolding, for those of you that remember that. And when we hit all-time highs in 1980, right before the 1981 recession, we were also in a rate hiking cycle. We were just coming off of when Paul Volcker raised rates to 20%. That was a different time. And the last thing that I want to talk about, guys, is earnings. So as of the time of this recording, we are going to be seeing mega cap earnings start to report next week. Now, from what we've seen already, there are big tech layoffs that are starting. So there's Google, Amazon layoffs. And if you take a look here, you start to see layoffs in the retail sector. Macy's just announced that they're going to be closing 5 stores, laying off more than 2,300 employees. So what tends to happen is this actually fuels stocks in the short term because layoffs mean that the company will be saving money or retaining more cash flows. But in the long term, if more and more layoffs happen, then obviously that is going to create a bubble burst in the economy where unemployment starts shooting up and then nobody can pay for anything. The economy starts to crash and then the stock market starts to crash with it. So in short, I do think that this is definitely one of these scenarios where you have to have your antennas really highly tuned at the moment. Obviously, we could continue to run up until we hit the psychological level of 5,000 on the SPY. Like I said before, nobody can tell us when this will uninvert. It could be in the next couple months. It could be by the end of the year. Nobody is really good at predicting recessions like that. I just personally think that based on the conditions that I just talked about, so the yield curve uninversion, obviously being an election year with peak rates, that's a very important distinction there as opposed to just being in an election year. Hitting all-time highs with peak rates as well. So in terms of what I'm doing right now to position myself, I started selling calls against my share. As I told you before, and I know some of you don't like to hear this because you've been listening to fear porn channels the whole time telling you not to buy, right? But when we started buying in 2022 and then also in 2023 during this correction, we already did the buying. So right now you have a decision whether you want to hold, whether you want to sell calls against your shares, whether you want to take profit, as opposed to someone who's trying to put money to work and they have no idea what to do. For me, I would absolutely hate right now if I was trying to make a decision of should I buy here, right? This is the type of buying that for me is just incongruent with my style of investing. So what I'm looking to do here is take some profit on certain things that I think are a little riskier. So things like Unity, things like Celsius, these are stocks that were given a chance to rally because of the liquidity and the hysteria and the squeeze, etc. But these are things that I do not want to hold going into these types of conditions. Now, stocks that I bought, on the low, like buying the S&P 500 for less than $400, some of the Tesla that I bought at 100, like, do I really want to let that go? Probably not. As I said, a good entry gives you the chance to really decide whether to hold here or not, and you don't have to make a tough decision of whether to buy. So I'm selling calls against my share. I'm selling some of the riskier stocks that have run up and I don't really care to hold at all. And I think there might be, if the yield curve uninversion takes a while and we are going to see a pump, which is definitely very possible if we continue this pump until that happens, and we see 5,000 on the S&P 500, I do think there will be a short-term rotation into things such as small caps, into beaten up stocks. Like we've been holding PayPal, I think since 59. Sorry, we got in PayPal November 2nd and it was at 55 and it just hit 65 last week. So there are certain things like that. And then obviously looking to make a play on bonds as short-term yields will continue to drop, fueling a rally in bonds. So that's how I'm positioning myself right now. And if you want to follow exactly what I'm doing with regards to option selling, with regards to which stocks I think are going to get rotated into in the short term, with regards to taking profit on certain risky stocks, make sure that you are following me down below in our Discord. Sign up to the premium membership. Use the discount code below. We are going to be closing January 31st. to the public, and then it will be waitlist application only. So make sure that you sign up using the link below. Would love to have you come through, check us out, leave a comment down below. Let me know if you want me to do a detailed video, like a top stocks to buy video, what I'm looking at right now, even though the conditions in my view are really ugly and I don't like buying the highs. Subscribe to the channel, hit that notification bell, stay safe out there, traders. Peace.